Yo, 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 yo. Let's see how the markets react to NFP then. Not NFP, FOMC, sorry. Let's do multi-market view. So literally in a moment, we're going to see price come down. So they didn't change the rate as expected. So we expected that they're not going to change the rate. So that's come out as forecast. But obviously you expected that. You can literally see on Forex Factory right here in 1 second. See, you can see in Forex Factory that they've not changed anything. They've literally kept it the same right here. So now we just need to wait for the statement. Hopefully it won't be much longer. And we can find out what's going on with the market. So seeing price move a little bit. If you've got any pairs you want me to have a look at or anything, go ahead and ask in the chat, and I'll switch the chart over there so you can have a look at some specific pairs if you guys want to have a look. I hope it won't be long till the start of the press conference. Looking at around 30 minutes. So I'm going to stay on the stream, see how price moves, and then wait for the press conference, and we'll watch that and see what's being said in the press conference then. Bitcoin's coming down a bit. Look at that. Bitcoin's coming down. Wow, okay. It's literally come down 0.5%. So Bitcoin's come down quite a bit. And then GBP USD's come down 13 pips. USD JPY is up. Gold is down. We'll find out what his statement is anyway when they start the press conference, because he's gonna give his opening statement then. So we can watch that and find out what his statement actually is. If you're here, please like and share and subscribe. I'd really appreciate it. It does help a lot. Fed leaves rates unchanged for the fifth straight meeting. Fed voted 9-2 to keep interest rates unchanged. Wow. Go and sleep. Yara, there's live stream for FOMC. It's FOMC live stream, bro. Indications suggest growth of the economy moderated. Inflation in the US remains somewhat elevated. Employment remains low and labour market is solid. Waller and Bowman dissent prefer a 25 basis point cut. The Fed pause continues even as Trump calls for a 300 basis points of rate cuts. So that's interesting. Trump is calling for rate cuts, but obviously 7 of the people are against doing a rate cut. Only 2 people are keen in light of doing a rate cut. So that's interesting. Rahib, bro, when you going to sleep, man? It's late for you now. Isn't it like 11:30, bro? I'm sure it's like 11:30 for you, man. I would have slept early today, but just to see FMC, I sacrificed it. Boring news. No, we need to wait for the press conference. The press conference at 7:30, so 20 minutes. That's where the volume happens, in the press conference. I want to see EU fly. EU's gonna fall. EU's gonna fall. This is gonna push the DXY up. A lot of people are expecting the dollar to become strong based off the back of this news. With FOMC, we're expecting there to be rate cuts to be held. We've got 7 people saying that we don't want to do a rate cut. Only 2 people asking for a 25 basis point cut. So the majority favor that holding the rates, you know. So that's going to strengthen the dollar. And when they ask Jerome Powell about GDP and stuff like that, naturally he's going to give a positive view on GDP and the economy in the USA. So I'm expecting the pound, the dollar to rally off of the back of that. By the way, Trump also implemented a 40% additional tariff on Brazil. Trump imposes universal 50% tariffs on imports of semi-finished copper products. Trump imposes universal 50% tariffs on imports of copper-intensive derivative products. Trump says he's going to have a very clear deal with China, and Trump says BRICS is an attack on the US dollar. That's interesting. And Trump says he's negotiating with India. It's interesting how he's doing these tariffs just as the Fed is saying that we're not gonna cut rates, we're holding rates. So it's interesting to see Trump have a tariff heavy response based off of the back of that. It's as though he's trying to encourage the Fed to do something. Very suspicious, I must say. So all that's gonna do is just Trump just wants the Fed to cut, now JP not wearing it. Yeah, exactly, Lee, that's it. I mean, I don't know if you've seen or not, but you know, if you followed the Kabasi letter on Twitter, on X, the Kabasi letter, he literally just says, yeah, that Fed leaves the rates unchanged for the fifth straight meeting, yeah. So the fifth time they're not changing the rates, yeah. And the Fed voted 9-2 to keeping interest rates unchanged. So 7 out of 9 people voted to keep the rates the same. Only 2 people said they want to obviously change the rates and stuff. But those 2 people are very much in keen support of Trump. So that's interesting. Inflation in the US remains somewhat elevated, unemployment rate remains low, and labour market is solid. So I'm expecting Jerome Powell to say, especially with the recent GDP data coming out strong at 3%, I'm expecting him to say, listen, we're not planning on cutting rates. I wouldn't be surprised if there isn't any rate cuts this year. If we see August data in September come out strong also. That would be the 6th month in the row of the 6 months, half the year, that the Fed said we don't need to cut because the economy is doing okay. So this to me is definitely interesting. But Lee, did you see how Trump's put all the additional tariffs on everything? He's put additional tariffs on stuff. So obviously that's rather suspicious. The other auditing for JP's job, both Berman and Waller or Hawkins are suddenly the best. Exactly, that's what I'm saying. India and Brazil, yeah. But he's also done Universal. He's also done Universal one, yeah. So Trump implements additional 40% on Brazil. Trump imposes universal 50% tariffs on imports of semi-finished copper products. Yep, exactly. Copper's falling off of a cliff. Trump imposes universal tariffs of import of copper-intensive derivative products. So anything copper-based. So he's been quite tough on copper exporters, or whatever you want to call it. Yeah, this is interesting, bro. Very interesting. But I find it funny how he's doing all of this, right? Literally moments after the Feds come out and said that we're not cutting rates. And it's 7-2. And as you pointed out, Bowman and Waller are obviously on the opposite end. So I find that rather interesting. It's as though Trump's trying to cause potential recession to force the Fed's hand at cutting rates or doing emergency rate cut, which is why he's being extra. India also copying it because it is a member of the BRICS nations, yeah. But India, they're a joke anyway. I wouldn't even pay attention to India. They're hardly a strong economy. I wouldn't expect much from India, to be honest. Meeting is gonna start soon. 13 minutes the meeting will start. That's bullish for gold if he invokes a recession. That's what I'm talking about, yeah. I think, bro, Lee, literally, I think, yeah, he's trying to do whatever he can do to get rate cuts to happen. Which is why he's chucking all these additional tariffs on, which is just going to weaken the dollar. I bet we're going to see a bit of a drop in the dollar, you know. I genuinely expect that we're going to see a bit of a drop in the dollar off of the back of that. Nick made another stream, by the way. I'm not sure why he made another stream for like 20 minutes and then closed it again. And that's because he needs to reduce the interest on his baby. Exactly, he does. He does. He's put himself in a sticky situation, man. He's not thought about it. He should have sat down with the Fed, Jerome Powell, had a discussion, said, this is what I need to do. This is what I want to do. Help me meet that goal. What can we do to help the economy get to the point where we're able to rate cut? If he did that, he would have been in a much better off position instead of going in all guns blazing, saying, you have to cut the rates now, or we're gonna, you know, do this, do that. Yes, Alan. It's a trading battle. That's why you chose the stream. Oh, what do you mean? Alan, my guy, welcome. So basically, Alan, yeah, what you missed out is after the Fed, there's 9 people, yeah. 7 out of 9 said we're not cutting rates. 2 said we want to cut rates, yeah, but those 2 are the ones who want Jerome Powell's job. So basically, the Fed's pretty much comfortable saying we're not cutting rates. As soon as that happened, Trump came out and he said, I'm going to put 50% universal tariffs on copper. So coppers fell off a cliff. And he's put 40% additional tariffs on Brazil. I'm not sure why Brazil, maybe the copper based or something like that. Trump's annoying, man. Yeah, he's doing a lot of stuff. I think he's trying to force the Fed to cut rates by putting the dollar in a really bad situation where Jerome has to literally come out and do emergency rate cuts. I think that's what Trump's trying to force him to do. So you can see here on the 30-minute candle, yeah, we're pushing down. The USD/JPY wick down and started to come up again. Dollar's slightly down off of the news. So there's a dollar off the news on the 30-minute time frame. Trump is driven by egocentric narcissist. That's why he does things the way he does. Yeah, he does. He tries to force things his way. But he doesn't understand it in economy. It's not like that. You can't force things to be the way you want it to be. I'm going to have a look at oil, actually. I can't trade oil. My broker doesn't have oil. Oh wait, yeah they do. My bad. That's what I'm saying, innit? There's no need to cut rates when the economy is doing so well. I mean, you know, the 3% GDP is the reason why the economy is doing well. That 3% GDP. That's a big figure, bro. That's a really stout figure for the dollar. Give his fundamental lessons, son. Yeah, chill out, lad. This is more politics, to be honest, than it is fundamentals. This is more political. than it is fundamental, to be honest. There's a lot of politics going on right here. Well, I know Trump needs to go, and I completely agree. He needs to get gone. The guy's taking the mick out of all of us. Better annoying him. Yeah, he is. I'm looking at Bitcoin as well. Bitcoin's not really affected so far, interestingly. Now, oil's coming down hard. Look at that. Oil was up 1%. Well, probably like 1.5% actually. So we'll see what happens, innit? I think, Lee, I don't know what your opinion is, but I think that we might start getting a bullish dollar. I know you was on about price pulling down again, but I don't think we'll make another leg down. He's causing market uncertainty with his undermining of the Fed and his tariffs. Yes, exactly, he is. It's great for gold. But in the midst of whatever Trump's doing, the data is showing that the economy is doing well. So even though he's doing all these tariffs and stuff, the economy is resilient. And I think I don't think that's what Trump wanted. I think Trump wanted the economy to slide a bit so he can say to Jerome Powell, look bro, look at the economy is going down. The economy is crippling. We need to do rate cuts on there. So I think that he was kind of banking on that to occur. But obviously, as you can see with the GDP data and stuff like that, the economy is quite resilient, isn't it? So I think he was probably surprised by that. So personally, I think if price makes a leg down, it's probably gonna make a leg down to like 97.5, and then it's gonna go up from there. But I don't expect it to come down below 97 dead. I'd be shocked if price comes down to make another potential low. I'd expect it to do a bit of a drop to about 97.5-ish, 98, and then potentially rally from there is what I'm expecting from the dollar itself. What I meant to say earlier is that Indians buy oil from Russia, which Trump ain't happy about. So that's also why country is getting tariffed so heavily. It's not even that. There's other things. I think he's buying weapons and stuff like that from Russia also. I think there was a statement on weapons and stuff. So yeah, that's what it was. I think it was weapons, from Russia. I think that's what it was, because there's oil as well, but there's something else too. For sure. Just waiting waiting for this press conference to start. It won't be long now. It's going to be a few minutes where the press conference starts. What news have we got tomorrow? Bank of Japan's rate cut decision. That's interesting. And there's a press conference. And then we got core PCE and employment cost index and unemployment claims. Right, so I might not be able to trade GBP JPY tomorrow, depending what time they have the press conference and stuff like that. Myself and Bola and Chris Pulver reckon 90 is probably a target for the dollar. I think that if JP is going to come out then saying we're doing well, I don't see that occurring. If Trump says something stupid, which he probably will, then like a catalyst, like a big catalyst for it to go bearish, then yeah, it could go down. Of course, it's possible. But from the economy perspective, the dollar should not drop any more than what it has, because we started to show strong economy. We're showing a resilient economy, and we're showing that tariffs so far haven't had an impact at all. But obviously, if he does something crazy, like says, "Oh yeah, we're gonna put our 200% tariffs on," and goes back into a trade war again, then obviously that's going to just push the dollar down even more, ain't it? You know what I mean? Let me just switch the trading view to that. So yeah, look, I'm gonna be careful of London session tomorrow. Here we go. Tell me if you can hear it okay or not, because obviously I won't know. Just waiting for JP. Here we go.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Despite elevated uncertainty, the economy is in a solid position. The unemployment rate remains low, and the labor market is at or near maximum employment. Inflation has been running somewhat above our 2% longer run objective. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged.
Can you hear that clearly, yeah?
We believe that the current stance of monetary policy leaves us well positioned to respond in a timely way to potential economic developments. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that growth of economic activity has moderated. GDP rose at a 1.2% pace in the first half of this year, down from 2.5%.
Yeah, that makes a lot of sense actually, Lee.
Although the increase in the second quarter was stronger at 3%, focusing on the first half of the year helps smooth through the volatility in the quarterly figures related to the unusual swings in net exports. The moderation in growth largely reflects a slowdown in consumer spending. In contrast, business investment in equipment and intangibles picked up from last year's pace. Activity in the housing sector remains weak. In the labor market, conditions have remained solid. Payroll job gains averaged 150,000 per month over the past 3 months. The unemployment rate at 4.1% remains low and has stayed in a narrow range over the past year. Wage growth has continued to moderate while still outpacing inflation.
Wait, tell me which one you're on about.
Overall, a
when you
wide
see
set
it,
of
tell me.
indicators suggests that conditions in the labor market are broadly in balance and consistent with maximum employment. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.5% over the 12 months ending in June, and that, excluding the volatile food and energy categories, core PCE prices rose 2.7%. These readings are little changed from the beginning of the year, although the underlying composition of price changes has shifted. Services inflation has continued to ease, while increased tariffs are pushing up prices in some categories of goods. Near-term measures of inflation expectations have moved up on balance over the course of this year on news about tariffs, as reflected in both market-based and survey-based measures. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5% and to continue reducing the size of our balance sheet. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. Changes to government policies continue to evolve, and their effects on the economy remain uncertain. Higher tariffs have begun to show through more clearly to prices of some goods, but their overall effects on economic activity and inflation remain to be seen. A reasonable base case is that the effects on inflation could be short-lived, reflecting a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to keep longer-term inflation expectations well anchored and to prevent a one-time increase in the price level from becoming an ongoing inflation problem. For the time being, we're well positioned to learn more about the likely course of the economy and the evolving balance of risks before adjusting our policy stance. We see our current policy stance as appropriate to guard against inflation risks. We're also attentive to risks on the employment side of our mandate. In coming months, we will receive a good amount of data that will help inform our assessment of the balance of risks and the appropriate setting of the federal funds rate. At this meeting, the committee continued its discussions as part of our 5-year review of our monetary policy framework. We focused on potential revisions to our statement on longer-run goals and monetary policy strategy, and are on track to wrap up any modifications by late summer.
Hello, Mr. Fahad
Two
Yamar.
goals for monetary policy: maximum employment and stable prices. We
Hamad
remain
Yar.
committed to supporting
Hamad Yar,
maximum
sorry.
employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Thanks, Chair Powell. There's a lot of lean in the markets, and not to mention out of the administration for a rate cut now in September. Is that expectation unrealistic at this point?
So, as you know, today we decided to leave our policy rate where it's been, where I would characterize as modestly restrictive. Inflation is running a bit above 2%, as I mentioned, even excluding tariff effects. The labor market's solid, historically low unemployment. Financial conditions are accommodative, and the economy is not performing as though restrictive policy were holding it back inappropriately. So it seems to me and to almost the whole committee that the economy is not performing as though restrictive policy is holding it back inappropriately, and modestly restrictive policy seems appropriate. All that said, there's also downside risk to the labor market. In coming months, we'll receive a good amount of data that will help inform our assessment of the balance of risks and the appropriate setting of the federal funds rate.
So just to follow up, by coming months, does that include the possibility you'll be getting essentially 2 rounds of jobs and inflation data between now and the September meeting? Is that potentially adequate to make a decision to lower rates at that point?
So you're right. We do have, this is an intermeeting period when we'll get 2 full rounds of employment and inflation data before the time of the September meeting. We have made no decisions about September. We don't do that in advance. We'll be taking that information into consideration and all the other information we get as we make our decision at the September meeting.
Steve.
Thank you, Mr. Chairman. You took out the word or the notion that uncertainty has diminished from this statement. Does that mean uncertainty has increased? And I'm just wondering, the administration has struck several deals with large trading partners where it seems like we now know what the rate is going to be. Does knowing that rate add to your certainty to change policy, or do you need to wait to see the economic effects?
So essentially, the statement in our statement about uncertainty reflects what's gone on since the last meeting. So at the time of the last meeting, uncertainty had moved down a little bit, but it was more or less even this time. So we took out, had diminished because it didn't diminish further. So there's not really much in that. And then your second question is, say again?
There have been several deals that have been struck, and now we seem to have an idea of what the tariff rates are going to be with some of our large trading partners. Does that not add to the kind of certainty you might need, or is it you're waiting for the economic effects to show themselves?
No, I think we're still, you're right, it's been a very dynamic time for these trade negotiations, and lots and lots of events in the intermeeting period, but we're still a ways away from seeing where things settle down. We are clearly getting more and more information, and I think at this point, people's estimates, our estimates, outside estimates of the likely effective level of tariffs is not moving around that much at this point. But at the same time, there are many uncertainties left to resolve. So yes, we are learning more and more. It doesn't feel like we're very close to the end of that process, and that's not for us to judge. But it feels like there's much more to come, as well, looking ahead.
Neil.
Hi, Mr. Chairman. Neil Irwin with Axios. This morning we got a GDP report in which final domestic private purchases decelerated, slowest pace since 22. There was a weakness in the interest-sensitive sectors and residential investment, commercial structures. Are those not signs that monetary policy is a little too restrictive right now, given current economic conditions?
So the GDP and PDFP numbers came in pretty much right where we expected them to come in. You got to look at the whole picture. So certainly, as I mentioned in my opening remarks, economic activity data, GDP, private domestic final purchases, which we think is a narrower but better signal for future, for where the economy is going, has come down to a little better than 1%, 1.2%, I think, in the case of GDP for the first half, whereas it was 2.5% last year. So that has certainly come down. But if you look at the labor market, what you see is, by many, many statistics, the labor market is kind of still in balance. It's things like quits, job openings, and let alone the unemployment rate. They're all by many measures, very similar to where they were a year ago. So you do not see weakening in the labor market. You do see a slowing in job creation, but also a slowing in the supply of workers. So you've got a labor market that's in balance, albeit partially because both demand and supply for workers is coming down at the same pace, and that's why the unemployment rate has remained roughly stable, which is why I said we do see downside risk in the labor market. I mean, our two mandate variables, right, are inflation and maximum employment, stable prices and maximum employment, not so much growth. So the labor market looks solid. Inflation is above target, and even if you look through the tariff effects, we think it's still a bit above target, and that's why our stance is where it is. But as I mentioned, downside risks to the labor market are certainly apparent.
So on labor, given the fluid labor supply situation, is there a number for this jobs report we get on Friday that would look to you like equilibrium job growth?
You know, the main number you have to look at now is the unemployment rate, because if it's true that the demand for workers in the form of, let's call it, just say payroll jobs, that number has come down, but so has the break-even number, kind of in tandem. So, as long as that puts the labor market in balance.
Look at the charts here.
Declines in both supply and demand.
Pushing down quite hard.
It is suggestive
US
of
30
downside
is a bit
risk,
mixed.
So we, of course, we'll be watching that carefully.
Bitcoin's down. UJ's up, gold's down, dollar's pushing up again.
Thank you. Colby Smith with the New York Times. Two of your colleagues called for a quarter-point cut today.
Is this who you're talking
what
about?
aspects of their argument were most compelling to you, and how you're weighing their views against those on the committee who, as of the June forecast, were in the camp of the Fed holding interest rates steady for the remainder of the year. And just in terms of the June SEP in particular, is that still the best representation of where the core of the committee is?
So on the dissents, what you want from everybody and also from a dissenter is a clear explanation of what your thinking is and what are the arguments you're making, and we had that today. So I think basically this was quite a good meeting all around the table where people were thought carefully about this and put their positions out there. As I mentioned, the sort of the majority of the committee was of the view that inflation's a bit above target, maximum employment is at target. That calls for modestly restrictive, in my way of thinking, modestly restrictive stance of policy for now. But we had two dissenters who I think, you want that clear thinking and expression of your thinking, and we certainly had that today, I think all around the table. In terms of, you ask about the June SEP, I wouldn't. That you're right. That's what it says, and that may well. I couldn't point to it 6 weeks later as expressing people's thought. You really can't do that. We don't run an SEP, and I don't like to substitute in my own estimate of what the SEP might be. We don't have one. So I'll just say that we haven't made any decisions about September. We'll be monitoring all the incoming data and asking ourselves whether the federal funds rate is in the right place.
And just on the point about policy being only modestly restrictive, does that mean that there's actually not much scope to reduce rates once the conditions for a cut are met, barring a significant weakening of the labor market?
So let me say, my own estimate is modestly restrictive, and there are a range of
out
views
of 10, I'd give her literally a 5 or a 6 out of 10.
For our
Hardly
economy,
anything
and so
special.
others may say it's more restrictive or less restrictive even. We're going to be at some point when we return to moving toward a more neutral stance, we'll be making that judgment as we go. I don't think we have a preset course. It's not so mechanical as saying, we've derived with great confidence the neutral rate and that is our destination, because really we understand that no one actually knows what the neutral rate is. We know it by its works, and that will be how the way the economy reacts over time to slightly looser policy.
My guy is tweaking.
Nick Timmeros, The Wall Street
She isn't
Journal.
even all that,
Chair
bro.
Powell, my question is about what have you learned over the last few months about the inflation generating and price pass-through process? And just to drill down, the June CPI report showed evidence of tariff-induced goods inflation. Now, the tariff landscape is only starting to be settled with some of these more recent deals. Given the lags between when tariffs are announced and when they show up in goods prices, is 2 months a long enough horizon to evaluate the impact and be confident that tariffs aren't impacting the broader inflation process?
I think you have to think of this as still quite early days. And so I think what we're seeing now is substantial amounts of tariff revenue being collected on the order of $30 billion a month, which is substantially higher than before. And the evidence seems to be mostly not paid only to a small extent through exporters lowering their price, and companies or retailers, sort of people who are upstream, institutions that are upstream from the consumer, are paying most of this for now. Consumers it's starting to show up in consumer prices.
Look at the.
We expect to see
look
more
at
of
the
that.
DXY. I mean,
and we know
that
from
is
surveys that
flying.
companies feel that they have every
DXY is
intention
going
of,
for it.
of putting this through to the consumer, but the truth is they may not be able to in many cases. So I think we're just going to have to watch and learn empirically how much of this and over what period of time. I think we've learned that the process will probably be slower than expected at the beginning, but we never expected it to be fast. We think we have a long way to go. To really understand
she's
exactly
all right,
how
but I
it will be.
wouldn't say she's
So
amazing.
that's how we're thinking
I'd
of
give
it
her
right
like
now.
a 5 or
So if I
6
could
out of
follow
10.
up,
She's
is
about
the
average.
reticence to look through core goods
She's
inflation being
average.
driven by the judgment that during the pandemic expectations proved more adaptive than anyone at the Fed expected? Is it being driven by uncertainty over how restrictive policy is?
You could argue we
Yeah,
are
yeah,
a bit
Lee.
looking through
He is so handsome.
goods inflation by
Do you
not
want- do you want
raising
me to
rates.
headbutt you,
We
bro?
haven't reacted to new inflation, but I mean,
swear down,
I wouldn't
man.
insist upon that. But
This
I
perfect
don't
time.
think. I think the
Nah,
base
Lee,
case,
you're
I
my
said- as
type,
I
you
said,
are,
a
mate.
reasonable base case
I'm into
is
you,
that
Lee.
these are one-time.
Oh, dear.
One-time price effects.
Okay, look at.
Of course, in the end, there will not be. This will not turn out to be inflation.
Look at
because
the
we'll make
charts,
sure
man. Look
that
at
it's
the
not. We will, through our
charts.
tools, make sure that this does not.
Yeah,
move
Euro
from being
USD down
a one-time
0.8%,
price increase
GU down
to
0.6%,
serious inflation.
USD
We wanna do that
JPY
efficiently, though.
almost
Efficiently. And that
0.5%,
means
gold is
you wanna
down
do it,
minus
if you move too soon,
1.15%.
you wind up
you-
maybe not getting inflation all the way.
S&P
fixed,
500
and you
is
have to
just
come back. That's inefficient.
mixed
If
review.
you move too late, you might do
Oil,
unnecessary
nothing.
damage to the labor
Bitcoin's
market.
down hard.
There won't
Dollars
be in the
up
end
with
any
serious
big inflationary
momentum.
problem. What we're trying to do is accomplish that in a way that is efficient. But in the end, there should be no doubt that we will do what we need to do to keep inflation under control. Ideally, we do it efficiently.
Michael McKee from Bloomberg Television and Radio. The one big bill, leaving aside the adjectives, do you expect it to add stimulus to the economy in 2026? And would that be an argument for remaining on hold or cutting back on the number of rate cuts you would expect for next year?
So, of course, let me just ritual disclaimer that we don't express any judgments or anything like that on fiscal legislation or other legislation for that matter. But I would say when you think that, the biggest part of the bill was making permanent existing law on taxes.
I just typed in
I don't
DXY
think we
in
see
it.
it as particularly
And
stimulative.
it's
There should be some stimulative effect,
DXY TVC.
but it shouldn't be significant over the next couple of years.
And to follow up,
Better not be what?
what do you, well, I don't want to put this in terms of you and the president, so let me ask it this way.
Look at that, bro.
Do you have concerns
Yeah, look at that.
about
Look.
the cost to the government
It's almost at
of
100.
keeping rates elevated
Bitcoin's
for
down,
longer
bro.
in terms of interest rate charges?
Oof, look at that.
That's we have a
Look
a
at the
mandate
charts.
that's
I'll
maximum
flick to the
permanent
charts.
price stability, and it is.
Look at this.
It's not something we do.
Look, gold is like
to
pizza,
consider,
bro. Pizza.
the cost to the government.
So long,
Of
sucker,
our
even
rate
dirty.
changes. We have to be able to look at
Gold is down.
the goal variables Congress has given us, use the tools they've given us to achieve those goals, and that's what we do. We don't consider the fiscal needs of the federal government.
Yeah.
No advanced economy central
I knew
bank
price
does
is going to
that.
come to that zone. I
And
agree
it
with
wouldn't
that.
be good for.
That zone got
if we
whacked
did
hard.
do that, it would be good neither for our credibility nor for the credibility of U.S. fiscal policy. So it's just not something we take into consideration.
Victoria. Hi, Victoria Guido with Politico. When it comes to the renovations of the Federal Reserve's headquarters that the administration has been looking into, do
Go to
you see
GBP,
their
one
interest
sec,
in
one
that
sec.
issue as being directly tied to the president's push to get you to lower interest rates?
Not for me to say. I will say we had a nice visit with the president. It was an honor to host him. It's not something that happens very often at the Federal Reserve to have the president come over, let alone to visit a building. But it was a good visit.
Are there any
Yeah,
aspects
exactly.
of the project that they've raised that you see as making you reconsider any aspects of the project?
I mean, it was falling
So,
anyway. Euro was. It's
This
already
project
falling
was
against it
hatched and
anyway.
conceived almost a decade ago now, and we went through the very long process of clearing it through historic preservation at the National Capital Planning Commission, and a lot of back and forth there. It was very constructive.
A lot of
We
movement
started out
here,
to do
Lee.
the work,
A lot of movement.
and we're very well along on that work. And I was quite pleased to have the president say multiple times that what he really wanted to see was us getting this construction completed as soon as possible. That is our focus, and that's what we're going to do.
Thanks, Mr. Chairman. Andrew Ackerman with the Washington Post. What message do you take from the fact that inflation hit 2.1% last September and has bounced higher since? Why do you think financial conditions are restrictive and a neutral rate's below 4% when inflation has stopped falling for almost a year?
So inflation, when you talk about these 12-month inflation measures, you're always battling residual seasonality. So we'll have, for example, 2 months of high inflation sometimes early in the year, and then inflation turns lower, and a lot of that may just be an artifact. So that's why we look at the 12-month numbers. I think inflation is most of the way back to 2%. There are things like the catch-up inflation. So, for example, all the insurance costs that they're only now going through inflation, but they actually reflect inflationary pressures from 2-3 years ago. So that's got to go through. In addition, now we have 3 or 4 tenths of inflation in core inflation from tariffs. So, and we can't really separate that out. We're not going to have a separate kind of inflation that isn't the tariffs. We're always going to be dealing with all of inflation. But the composition, as I mentioned, has really changed. And if you go back to the last couple of years, it was all about services inflation, which was being very sticky. Now services inflation is coming down nicely. Goods inflation was well behaved before, and now goods inflation is going up. So the story has really changed. That's partially because of tariffs. It's also partially because we had restrictive policy in place, and we've seen that the result of that gradually work its way through the services economy.
Okay, the other thing I wanted to ask is, are you comfortable
Let me have a look
VLS
at that.
can continue performing their mission effectively if they take an 8% reduction in headcount and authorized spending as the administration has proposed?
I'm not going to comment on the administration's proposal. I do think, as I've said, I think that we're getting the
Oh,
data
yeah,
that
you're
we
right.
need to do our jobs.
It's coming down, isn't it?
And
It's
I
coming
think
down
it's
a
really
wee bit.
important that good data helps
dropped
not
hard
just
in London
the Fed,
session.
it helps
Now
the
it's
government, but
dropping
also
again.
helps the private sector. People in the economy, they use this data a lot too. So it's quite important for our economy, and certainly for the Fed's work and other government agencies' work that we continue to get better at data. That's what we've been doing for 100 years. We've been getting better and better and better. It's very hard to accurately capture in real time the output of a $20+ trillion economy. And the United States has been a leader
S&P
in that for
500's
100 years,
down.
and we really need to continue that, in my view.
Whoa, look at S&P 500. Look here, bro, look. Wow.
Thank you, Mr. Chairman. Edward Lawrence from Fox Business. How concerned are you with the data that we're showing coming
Look
in,
at
showing
that.
no significant upward trend
Look at
in
that.
inflation over the past 6 months, that the wait-and-see approach for inflation is actually
And
giving
beat
companies
Bitcoin.
cover to raise prices?
How concerned am I that say that again?
The wait-and-see approach is
The
giving...
wait-and-see approach, what do you mean by that?
For cutting rates. You're waiting to see if the tariffs will affect inflation. So it's a wait-and-see approach.
Well, so that's where policy's restrictive. When we start cutting, it'll go toward neutral.
Okay. This delay, though, where you're saying there's a one-time price increase for tariffs, which possibly could lead into bigger inflation or more inflation. Is that giving companies cover, though, to raise prices?
Well, what may be giving, it's not our policy stance, what may be giving some companies will certainly be taking advantage of the fact of the tariffs and all of the discussion of how they're going to, if the companies will raise prices when and as they can. And you saw it famously in the first administration of President Trump during those tariffs. Washing machines were tariffed, but dryers weren't. But what do you know? The price of dryers went up too, just like washing machines. So companies will often just they'll cross the street in a group, if you know what I mean. That'll happen. We don't see a lot of that. I mean, what we see now is basically the very beginnings of whatever the effects turn out to be on goods inflation. And I'll say again, they may be less than people estimate, or more than people estimate. They're not going to be zero. Consumers will pay some of this. Businesses will pay some of this. Retailers will pay some of this. But
yeah, they are. I bet
we're
they
just
are.
going to have to see it through.
And just to follow, if I could, some additional tariffs have been in place since February, and things really haven't broken yet with the economy. So how do you justify to somebody who's looking for a house, who's facing a 7% mortgage and maybe can't afford those rates? How do you justify that?
Well, so the housing is a special case, right? We don't set mortgage rates at the Fed, right? We set an overnight rate, and the rates that go into mortgages are longer term rates, like Treasury rates. It might be 30-year rates, it might be shorter than that, but it's not the overnight Fed's rate. It's not that we don't have any effect. We do have an effect, but we're not the main effect. There are other things going on in the housing sector, and one of those is just there's kind of a long-term housing shortage that we have. We haven't built enough housing. This is not something the Fed can help with, and that'll be the case even after things normalize. So I think the best thing that we can do for housing is to have 2% inflation and maximum employment, and that's what we can contribute to housing. There are lots of other jobs to do for the private sector and Congress, but that's what we're trying to get to. We've made a lot of progress toward that. We have a very good labor market right now. Inflation, we were very close to 2%. We're seeing some goods inflation move us away, but so far not very far away.
Chris.
Hi, Chair Powell. Thank you. Well, can you give us a little more about what kind of economic data does the Fed need to see before you'll be ready to cut? I mean, do you need inflation back nearly to target? Are there other things in the pricing that you look for? Do you need to see weakening in the job market? What kind of things are you looking for?
I mean, ultimately, it could be any of those things, right? But if you saw that the risks to the two goals were moving into balance, if they were fully in balance, that would imply that you should move toward a more neutral stance of policy. This is the special situation we're in, which is we have two-sided risk to both of our goals. When we paused, inflation was above target and the labor market was pretty good. So that was a time when policy was restrictive when we paused. And to be restrictive is to be supporting a return to our inflation target, right? So as the two targets get back into balance, you would think you'd move in a way closer to neutral, and that the next steps that we take are likely to be in that direction. What will it take? It'll be the totality of the evidence. As I mentioned, there's quite a lot of data coming in, which before the next meeting, will it be dispositive of that? It's really hard to say. We don't make those decisions right now, so we'll have to see.
Well, I guess just in terms of inflation, though, for example, like some people would point to if it remains only in goods and it doesn't bleed over to services, then maybe that's evidence that the tariff effect is going to be a temporary one-time thing. Is that kind of thing affect your thinking, or do you just need to see the number come down closer to 2?
We'll look at everything. It's, as I mentioned, a pretty reasonable base case is that this will be a one-time price increase. And in the end, we'll make sure that that's the case. We're just trying to do that efficiently. And efficiently means getting the timing right so we don't, again, if we cut rates too soon, maybe we didn't finish the job with inflation. History is dotted with examples of that. If you cut too late, then maybe you're doing unnecessary damage to the labor market. So we're trying to get that timing right, and that's effectively what we're doing.
Claire Jones, Financial Times. Just a question on the dollar. We've seen it decline quite heavily this year. I was wondering if there's been any discussion about that at the meetings and to what degree that may be complicating your attempts to get inflation back to target. Thank you.
So this goes back to the.
It's weird hearing the accent in America.
The Treasury, as you I'm sure know, and the Treasury only speaks to the dollar. It's not something that's been a topic of major discussion at all at the Fed. I wouldn't say it doesn't come up. If the transcripts.
Can you 30-minute candles now being printed?
Of the dollar, but it would never be a major focus.
And just to follow on, if I may, to Andrew's question, I think the amount of imputed data in CPI now is up to 35%. I mean, Is there any discussion of that as well? Is there any consideration of looking at alternative measures, data scraping and so on, in order to just ensure you've got a good read on what's happening to prices in the US economy? Thank you.
You know, we're monitoring the situation. We do, of course, I mean, as you know, during the pandemic, we looked at a whole lot of new kinds of data. People are looking at big data sets that you can get from all sorts of places, and we do all of that. But at the same, we really need the government data. Really is the gold standard in data, and we need it to be, you know, to be good and be able to rely on it. And we're not going to be able to substitute for that. But you know, if we have to make do with what we have. But I certainly hope that we get what we need.
Jay O'Brien.
Hi, Mr. Chairman. Jay O'Brien, ABC News. President Trump has obviously invoked your name a lot. He has personally pressured you. Are you concerned the way that conduct might impact the Fed's independence going forward?
I'll just say that, so I think that having an independent central bank has been an institutional arrangement that has served the public well. And as long as it serves the public well, it should continue and be respected. If it didn't serve the public well, then it wouldn't be something that we should just automatically defend. But what it gives us and other central banks, what it gives you is the ability to make these very challenging decisions that in ways that are focused on the data and the evolving outlook, the balance of risks and all the things we talk about, and not political factors. And so governments all over the advanced economy world have chosen to put a little bit of distance between direct political control of those decisions and the decision makers. So if you were not to have that, there would be a great temptation, of course, to use interest rates to affect elections, for example. And that's something that we don't want to do. So I think that's pretty widely understood. Certainly it is in Congress. And I think it's very important. I'll just say that.
Bitcoin's down 1.6%. Euro is down 1.06. GBP is down 0.85.
Maria Luisa Capurro from Bloomberg News. You mentioned a slowdown in consumer spending, and I wanted to see if you could walk us through what was the discussion with the committee around that. We're seeing delinquency rates.
I remember China Bangladesh, the Golden Asia session.
Households. How do you see that evolving in the next few months, and how much of a vulnerability that is for the economy going forward?
Consumer spending had been very, very strong for the last couple of years, and had repeatedly forecasters, not just us, had been forecasting it would slow down, and now maybe it finally has. So I would say, if you talk to credit card companies, for example, they will tell you that the consumer's in solid shape and that spending is at a healthy level. It's not growing rapidly, but it's at a healthy level, and delinquencies are not a problem. You mentioned high-end delinquencies. I don't know what to make of that. I read the same thing. But so generally, and if you look at the banks, and when the banks talk about in their earnings calls, the performance of credit has been good. So essentially, you have a consumer that's in good shape and is spending, not at a rapid rate, but it's true, and it was again right in line with what we expected. The GDP data that we got this week. And I think it's still a little bit difficult to interpret because you have these massive swings in net exports, which may also be affecting, some of that can affect consumer spending as well. Look, it's one of the data points that we pay most careful attention to, and there's no question that it's slowed. And we're watching it closely, but we also watch the labor market and the performance of inflation. Those are our two variables that we're assigned to maximize.
And just to follow up on what my colleagues were asking about this sense, Governor Waller said that the labor market is on edge, and he was pointing to weaknesses on the private sector. I was wondering, you've said that the main number to look at is the unemployment number overall, but what was the discussion about the state of the private jobs market?
So I'm not going to talk about any individual's, comments. I wouldn't do that. But I think what we know is that private sector job creation, certainly in the last report we'll see on Friday, but had come down a bit. And if you take the QCEW adjustment seriously, it may be even lower, maybe close to zero. But the unemployment rate was still low. So what that's telling you is that demand for workers is slowing, but so is the supply. So that's it's in balance, oddly enough. You've got a very low unemployment rate, and it's kind of been there for a year as job creation has moved down. But also we know that, because of immigration policy, really, the flow into our labor forces is just a great deal slower. And those two things have slowed more or less in tandem. If you look at things like I mentioned, quits, look at wages. Wages are gradually cooling. Look at vacancies to unemployment. Those things have been pretty stable they haven't really moved a lot in a full year. So I think if you take the totality of the labor market data, you've got a solid labor market. But I think you have to see that there are downside risks. You don't see weakening in the labor market, but I think you've got downside risks in a world where unemployment's being held down because both demand and supply are declining. I think it's worth paying close attention to it, and we are.
Nancy.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. One more question on the lack of unanimity in today's decision, the two dissents. Was there talk during the meeting? I know you're not going to talk about what individuals said, but in general, was there talk during the meeting of cutting rates, and what was the case against that at the meeting?
Sure. So we have an economic go around where people talk about the economy, and then that's yesterday, and then today we have a monetary policy go around all the way around the table. Everyone gives their views. So the discussion around policy was the majority view was still what it has been, which is that inflation's running above target, maximum employment is right at target. That means policy should be a little bit restrictive, somewhat restrictive, because we want inflation to move all the way back to its target. So that's where people have been and still are. Two of our members felt that the time had come to cut, and that they, for the reasons that they're going to express, I won't tell you the reasons. They'll issue some kind of a thing in the next day or so. So, but that's the story, and I would say, well argued, very thoughtfully argued all around the table, good arguments, and it's a situation where, an unusual situation. The economy is in good shape, but it's an unusual situation where you have risks to both your employment mandate and your inflation mandate. That's the nature of a supply shock, and it's probably not surprising that there would be differences and different perspectives on that, as well as different views of where the neutral rate is, so that different views of how tight policy is. So we have those. I will say what you hope is that people, explain their positions very thoughtfully and clearly, and we absolutely had that today, all the way around the table. I would call it one of the better meetings I can recall from that standpoint.
And you've said you're waiting to be confident inflation is heading toward your 2% target before you start cutting rates. When you do get that confidence, would you be in favor of lowering rates right away?
It's not quite the way I would put it. I said that's why we think policy should be restrictive, is because inflation is above target. When we have risks to both goals, one of them is farther away from goal than the other, and that's inflation. Maximum employment's at goal, so that means policy should be tight, because tight policy is what brings inflation down. If you came to the view that the risks to the two were more in balance, that would imply that policy shouldn't be restrictive. It should be more neutral, a neutral stance, and that would be somewhat lower than where we are now. No one knows exactly where that is. So that's the framework I think I'd be taking, and we'll just have to see. We're going to be obviously looking at a lot of data in the next cycle. It is one of the cycles where we have 2 employment and 2 inflation reports, and we'll see where that takes us.
Jeff Fox. Thank you, Mr. Chairman, for taking the question. Jeff Cox from CNBC.com. A metric that you like to cite a lot is the final sales to private domestic purchasers. That was down to a 1.2% gain in second quarter from 1.9% in Q1, suggesting that there's some softening in underlying demand. I just wondering if you look at that and you combine that with some of the housing numbers, the weakness that you acknowledged at the top of your remarks, that the housing market is in fact weak, and the inflation numbers from GDP today came down to 2.1% for headline, 2.5% for core. I'm wondering how much more movement you would need to see from these data points before you would be comfortable with cutting in, say, September.
It's going to be the total. Hard to answer that specifically. PDFP, I think, for the first half, private domestic final purchases, or final sales, as people call it, was 1.6 on the first half. GDP, I believe, was 1.2%. That's the whole half. You mentioned the quarters. So those are.
I'm going to
slower,
probably watch
but,
for another 18 minutes till about
bumpy
8:30, and I think at that point we should be done.
Half to half, and often gets revised, after the fact. The labor market data we still think is, continue to think is the best data we have on the economy, and that shows a 4.1% unemployment rate. It shows wages, still at a healthy level, but moving ever closer to what we would regard as long-run sustainable, consistent with longer-run productivity and 2% inflation. So the labor market is actually still quite solid. Inflation is above target, even ignoring tariffs. It's a little bit above target, and tariffs. So we're watching all of that, and again, trying to do the right thing in what is a challenging situation, because you're being pulled in two directions, and you have to decide which of those it took to go in. And actually, at some point, if they're sort of equally at risk, then you really want to be at a neutral policy stance, which we're not right now.
So it'd be safe to say that if the data kind of stays in line with where it is right now, that you wouldn't be comfortable with cutting in September?
I'm not gonna say that. No, I just think we're going to need to see the data, and it can go in many different directions. The inflation data and the employment data, and we're going to make a judgment based on all of the data and based on that balance of risks analysis that I mentioned.
Thank you.
Greg, Rob, for the last question.
Thanks, Chair Powell. Greg Robb from MarketWatch. The Treasury Secretary has said recently that it would be confusing for the markets if you stayed on as a governor after your term as chair ends. And I was wondering if you had any update for us on a decision on that front.
Sorry, I do not have any update for you. Thanks very much, everyone.
Okay, that was it. So, pretty much then, one more sighting of Kobe and Aldi. One more sighting. She's alright, but I wouldn't say like she's 10/10 or anything. I'd say that she's alright, and that's about it. So yeah. Yeah, that's it. Trump speaking at 9 o'clock as well. He's gonna start chatting waffle. He's gonna start chatting waffle hard.
I wasn't made to wait any length of time. This was a real positive experience.
Right then, so basically, Lee, looks like rate cuts aren't going to be happening anytime soon, so the dollar's rallying off at the back of that, innit? I mean, look at the dollar. I think that we're not going to get rate cuts. Euros fell, GBPs fell. Gold was a big one, 1.5%. Bitcoin's bouncing back quite a bit, but you got 15 minutes left on that candle still. If you go on Bitcoin on the M15, that candle was still quite bad. Yeah, created a bit of rejection because I suppose. Someone pissed him off. Yeah, he was just like, I'm done. I think he's annoyed about all the stuff with Trump, you know. I think he's probably frustrated about that, all the Trump stuff. There's something about her. I don't know, she's alright. It's her eyes. She's got very nice eyes. Very nice eyes. But I can't see much more about it. Face is very standard. So yeah, my charts here. Get rid of that. Bashy, my real girlfriend wants me. Yeah, that's fine. Thanks for coming, Lee. I'm gonna close the stream now as well. Take it easy, bro. Thank you. No rate cuts yet. Yeah. We're done for rate cuts.